Good afternoon. Welcome back to another Hoya Capital webinar. Today, I'm excited to be joined by Brendan Maiorana, the Chief Financial Officer of Highwoods Properties. We're going to go through a couple of slides through their investor presentations, earnings, and supplement data. Turn off the presentation. Brendan and I will have a conversation. If you have any questions for us after, feel free to shoot us a message. You can reach Brendan on LinkedIn. He's very accessible. I'm sure he'll be happy to answer questions as well. But the goal here is to learn about Highwoods. So let's get into it. Starting out, the good old disclaimer, this compliance screen up here so that it's a CYA type situation. We'll leave this up for just a couple of seconds. I will note that all the information that we're going to be sharing has come from their first quarter investor presentation, their NAREIT deck from back in June, or their earnings press release that just came out here recently. For those that don't know, Highwoods, Sunbelt focused office REIT based in Raleigh. Big presence in Atlanta, Charlotte, Dallas, Nashville, Orlando, Raleigh, Richmond, and Tampa. FYI, I will be asking you about Dallas, 23 Springs, because that's here in our backyard. Very unique footprint. Brendan, been around the REIT industry a long time. Joined Highwoods in 2016. He was at Wells Fargo Research for many, many years. Rutgers and UNC. We won't ask him to pick allegiance on football teams or basketball. I'm sure we know where that lies. For those that don't know, here's a great snapshot from their presentation talking about Highwoods. Just under 27 million square feet of space at the end of March. Around, and we'll call it very close to 90% leased. This is from their investor presentation from the NAREIT presentation, just FYI. Big development pipeline. So a lot of interesting stuff here. This is a great map that shows their geographic footprint. I will be asking about Pittsburgh as we get into the conversation later on, but you could see their CBD versus suburban versus infill market presence here. And when you look at the diversification, obviously, we will kind of say a little bit banking heavy. That does lead to kind of the top of the list there. Government, architecture, very interesting lease stratification, as they call it here, looking at size per square foot leases across the board, looking at their growth of their rents, the construction pipeline, some very interesting stuff. Again, anybody can access this on the company website. Looking at expirations that's coming up ahead, the occupancy and where they see things going throughout the next year or two. And then this is a really interesting chart because we talk about their acquisition disposition activity. They're very transparent. Kudos to you guys for keeping this in your presentation that kind of shows this roadmap of how you guys have been navigating the landscape over the past several years when you're going acquisition heavy or disposition heavy. They do highlight some of their big recent acquisitions. For those that are in the know, we've been following 600 South Tryon for quite some time, obviously. The terraces here in Dallas, among other things, also the AAP Tower in Raleigh in their backyard. Selling off a bunch of properties. And what's interesting is that they've been selling non-office land as a source of capital. They're very transparent how they've been talking about this in their presentations about selling off land for sources of capital. And this is some of the deals that they've done here. They also talk about some of the recent development. As I mentioned, we will be talking about 23 Springs, since it is based here in my backyard. Also Granite Park 6, but this is just a couple of the deals. $474 million at their shares of, a pretty sizable chunk of change. Great story here is looking at their balance sheet. Obviously, I would say fairly strong, triple B rated here. Great access to capital. And the other thing here is that they talk about their debt maturity ladder. And this is one thing I love about our REIT industry for people that still look at the REIT sector through COVID lenses and, this wall of debt that's coming due in commercial real estate. And I always tell people you have to go to the company level. As my wife likes to joke, I like saying you have to peel back the layers of the onion and really get to the core here to understand what's going on. And what they're really telling you is that they don't have anything coming due until next year, which obviously they're going to be addressing sooner rather than later. But really, the next big, massive chunk would be out towards 2031 at this point. So it seems like they're able to navigate these waters. For those that missed their earnings, they did report FFO of 90 cents a share. NOI growth moving up, cash rents moving up, occupancy ended at 89.6. Big leasing quarter for them, placing Midtown East and Tampa into service. So I know, they always do a really good job here. And this is subsequent to quarter end where they've got some acquisitions closing, selling some assets. So again, the transaction machine continues to roll on. So with that, let's turn off the presentation Brandon, it's great to see you. Thanks for joining us today.
Yeah, thanks for having me. It's good to see you as well.
So obviously, the office landscape's changing dramatically, as we know. Work from home, though here to stay, hasn't really been impacting the REITs recently, I guess it's safe to say. We know what's going on in Sunbelt office versus the coastal office markets. But one big overhang that we talk about, and I'm not putting you guys in the same bucket as an SL Green, Vornado, the New York centric or the California focused guys like a Kilroy or Doug Emmett. But, you know, one of the things that the New York guys have been talking about is AI tenant demand. That the leases that have been signing have been coming from some of these AI and tech firms, and that's been kind of boosting the office sector. So with you guys having a different footprint, let's talk about AI tenant demand potentially in your portfolio. And let's say part two of that, we'll just go ahead and cover all of AI in one question. How does Highwoods benefit or is impacted by the growth of AI sector in general? ChatGPT, Claude, Anthropic, OpenAI, all that fun stuff. How are you guys impacted by that?
I would say that I think that there is definitely less impact across our footprint than I think what you see in probably the gateway markets, the coastal markets, whether it's New York or San Francisco or Boston, probably have a little bit more exposure to direct AI companies that are lessors of space. So we've done a few deals with AI companies in terms of one in Dallas we did at 23 Springs. So we did a 38,000 square foot lease there with an AI company. But for the most part, I would say the direct impact for us is relatively modest. And that's consistent kind of across broader tech, if you want to broaden that out a little bit. So sometimes that's a benefit to us. Sometimes that's a negative to us when tech is growing significantly as a user of office space. But I would say less impactful kind of overall for us in terms of direct leasing there. Tech broadly, including kind of like the TAMI sector, if you want to put it that way, which is in tech, advertising, media. That's about 7% of our customer base. So it's relatively modest. We're much heavier in terms of financial services, professional services, and then I would say just kind of general corporates tend to make up the majority of our overall tenant base. What we get asked questions a lot about, and I think there's often some theories or views on how AI may impact office demand. I think there's a lot of questions in our footprint about are our markets more back office heavy driven, and therefore are we more at risk for job displacement from proliferation of AI as it gets more widely adopted across the workplace. And we really don't have a lot of that exposure within our customer base or even kind of the submarkets in which we operate. So I think there probably is a little bit more back office in our markets broadly than maybe what you see in some of the coastal markets, but we don't think that exposure is that significant. Some of the data that we've looked at, there's about a 2% higher impact in terms of kind of administrative or back office functions in our markets versus the coastal or gateway markets. So somewhere around 25% in kind of coastal gateway markets, it's around 27% across our footprint. So it's a little bit bigger, but not dramatically. But that's really not within the submarkets or the BBDs, as we call them, that we play in. And so I like to use this anecdote that in our office building, our bankers for B of A is our largest customer in our portfolio. They sit in our office building in Charlotte. So my direct relationship banker sits there. The folks who run all of our credit facilities, they're in our office building in Charlotte. Same with JP Morgan in a different building, but also in Charlotte. Our bankers for JP Morgan sit in our building in Charlotte. So we have a lot of front office facing users, and there's some administrative functions like there are in any headquarter location that are in our portfolio, but it's not a lot. So we don't feel like we're exposed to direct exposure to potential job loss through AI adoption if there's back office job loss that occurs.
Do you want to comment on how you or the companies potentially implemented some of these AI machines and technology and how it might benefit shareholders?
Yeah, so we have, so what I would say broadly is I've been at the company for 10 years. Our G&A expense we've worked really hard to keep that G&A expense flat for kind of the 10 years that I've been here. So it's been right around $40 million of G&A, even though we've grown. I think when I started, our overall NOI was in the low to mid $400 million range, and our NOI this year is kind of north of $600 million. So we've had, roughly a 1/3 increase in kind of NOI while keeping that G&A level flat. Our ability to scale operations while keeping kind of our corporate level consistent, we think AI helps play into that. So I use AI. It's certainly on my end, it is a personal productivity enhancer. I would say that's the case largely for my team. What we have not done in a wide corporate level use yet is kind of expand that to routine processes where we've really implemented AI into the process. We're experimenting with that now and looking at potential solutions, and we think we've got some ideas where that may make sense. But we think that this will be somewhere where we can become more productive as an organization. Probably not going to lead to significant change in terms of headcount overall, but we think we're going to be able to grow the platform on a relatively steady level of personnel, and be able to kind of keep those costs that we've done for the past 10 plus years flat while being able to grow overall. So we think that it's got good potential across the organization. And I would say probably the two main corporate areas where we think we can implement it in terms of processes and production are across our IT department. So we have a lot of in-house applications that we built that we use across our systems. And there's a lot of coding that goes into that. So our IT team is certainly more productive, and we think we can become even more efficient with that, and then embed that into a number of our routine accounting processes as well. So we're experimenting with both those things, and we think that that will be some use cases as we go forward over the next year or so here.
And as you stated, if it helps keep G&A costs flat while helping unlock more additional NOI to the bottom line, then it's almost like a no-brainer to try to implement that as much as you can. And obviously, from the chairs that you and I sit in on, let's say the investor communications side, we know how powerful of a tool that is as far as dialogue, knowing your customer, how to answer those questions, call it setting the script, for when those potential inbound questions come in, and then it just kind of builds upon itself quarter after quarter and really helps refine that message. So very cool to watch that. All right, let's shift gears a little bit. You briefly touched upon, your footprint and the AI, impact on the tenant side. So I guess from a more broader perspective, how do you think the office landscape is going to evolve over the next 3 to 5 years?
So what I would say is, first of all, what we see right now across office landscape is there is record low supply construction pipeline for office space that is under construction and future deliveries right now. So what we're seeing from just an evolution of office, this is a little more tactical than it is kind of high level sort of strategic or evolution of where space is going to go to. But right now there is a lack of high quality space that is available in terms of what users want. So that gives us very good pricing dynamic in the current environment, where if you're a large user and you want a high quality block of space, there's very limited choices across our footprint. And so that gives us a level of pricing power that candidly we haven't seen since the onset of the pandemic. So that's part of the reason why our rents were up over 20% last quarter. We feel like we've got good ability to kind of push rents. Our net effective rents were the second highest that we ever recorded last quarter, and are at on a trailing 12 quarter basis, or trailing 12 month basis rather, are at record levels. So that dynamic from just a pure supply demand imbalance is benefiting us right now. I think longer term, as we think about the use of office space and how that is utilized and what customers want in a modern office space, I still think that location is more important than probably any other determinant. So we think that users want a place where what we like to say is the most important amenity is the neighborhood. And so if you're in a good neighborhood, that is probably your biggest kind of draw that's there. The physicality of the office space, it is evolving. I would say inside the four walls of your kind of office space, whether it's on one floor or half a floor or multiple floors, there's a little bit of tweak here and there. Those things tend to kind of bounce around a little bit and migrate. I would say what we have seen is there's the reduced space per user feels to have plateaued and maybe even backed up a little bit, where we had one broker who said, it was kind of like companies were trying to fit into skinny jeans and they realized that they can't really do that and they need to then sort of de-densify a little bit. So we've seen a little bit of that happen. But where I would say probably where we've seen a little bit more interest is in the common amenity packages that we have across our office buildings. So I think going back probably 5 to 10 years ago, having a fitness center, a conference center, and probably, a few good options for where folks could get lunch, whether or lunch, coffee, maybe something after work. Those all worked well. I think now what we're seeing is, especially for the highest end office, fitness centers are really kind of spa club-like level fitness centers that are there, often with towel service. A customer lounge tends to be very important. So in a lot of our lobbies in our buildings, we're building those out, where places where folks can go. That's not a conference center, but where you can just, if you don't want to be in your office, you want to sit down, maybe meet a colleague who also happens to office in that building or somewhere nearby, you can go sit down in a comfortable location that's there. And so we have built out more of those. And office is a capital intensive business. We can talk through kind of the CapEx loads that are required within office, but that is something that we plan for and try to make sure that the capital reinvestment that we're doing within our buildings, we think about that over many years and try to keep that relatively consistent year to year. Bounces around a little bit, but we've got a capital plan that we have for many years for all of our buildings that are there. And so we try to plan that and keep those numbers relatively consistent year to year. They bounce around a little bit, but we try to keep it, somewhere in that $60 to $80 million range and generally are in that level per year.
Let's give a plug to the new Torchy's at 23 Springs. I'm sure that place is doing very well. If you want to comment on how successful the debut of their largest store has been. But
I'll mention I was there a couple of weeks ago and the line was out the door, and but it was a great experience and they moved us through quickly. So yeah, it's doing well. And Little Ruby's, I think, is just open and doing well. And we've got Elefante that will open in the fall. So you'll have lots of options right at 23 Springs.
Did you forget to call me to meet you for lunch? I mean, what happened? Did my number get lost in the mail? I want to take a step back, though. Help me out here. The hypothetical situation. Evercore ISI calls up Ted and says, hey, we're looking at opening a southern headquarters in Dallas. What can you do to help us out? Can you maybe walk us through how that works? Does Highwoods go out and acquire land? Do you guys go into an existing property? Like, but for somebody who has no idea potentially how that works, kind of walk me through that.
Yeah. So it depends on scale, right? So size. So if they said, you know what, like we need 200,000 square feet, and we're putting we're moving our corporate headquarters, or we're putting a big regional headquarters in a given city. That's probably something that's not typically going to be available within our portfolio. It might be, depending on how things are. So we did look closely at Starbucks, who moved a big operation center from Seattle to Nashville. We ultimately couldn't accommodate them, but they signed a lease for 250,000 square feet in an existing building that was there. So that worked out well for them. But they were also exploring potential build-to-suit opportunities that were there. So sometimes when a requirement is very large, oftentimes what we may be able to do is do a shorter term small deal for the initial office that's there. And then while we're building out your new office on new development. It depends on what users want. So some users want to be in an office building with others, in which case we can think about that and we can start a pre-leased office with an anchor user and then have some spec space. Typically, if we're going to do that, pricing on that is probably going to be a little bit higher just because we're taking some risk with the residual office space that's there. So we've got to price that accordingly. If it's a build to suit, then that is something that we've done a lot of build to suits before as well. Then you can kind of tailor it to more what you're looking for as the customer. And then that rent function becomes a number of factors go into that, but location, how specialized the office building is, the lease term, all those things kind of play into what we do. And then a lot of times those will be a yield on cost deal. Sometimes that'll be a stipulated rent that's there. And then we would more take the risk on the development, but we usually wouldn't start a development without a gross maximum price contract from a general contractor. So typically we take fairly limited risk. And you might be alluding to it because we talked about development as something that we haven't announced a lot of development over the past several years. We've been more cautious on development, but we're starting to see a lot of that interest across our footprint from both build-to-suit users and from users who are looking for a significant anchor pre-lease on a development project that we may start.
I don't want to put words in your mouth, but I'll go ahead and ask. Does that mean there's an unlimited opportunity out there then?
Yeah, I mean, certainly capital is a scarce resource, so we've got to be judicious in terms of how we think about capital and not just capital that we're funding day one, but even those capital commitments that are there. So I think we're mindful of that. What I like to say is, we like to, when we think about development or we think about spending capital, we like to keep our risks relatively contained. So typically what we're going to try to do is if we're taking spec risk, we don't want to take a lot of financing risk that's there, right? You don't want to stack multiple risks on top of each other. So right now we're in a fortunate position where we've sold $375 million of properties year to date. We've got a lot of cash on the balance sheet that's there. Our balance sheet's in very good shape. So we've got kind of excess capital available to deploy. So there's not a lot of funding risk that we have if we're starting new projects. Now, there's a limit to that. It can't start, we're roughly $7-8 billion organization. We can't, kind of go too crazy. But we've got a lot of capital that's there. So we can think about some leasing risk, but we also want to be measured and we look for the best risk-adjusted returns that are there. So there's a lot of opportunity that's out there. We think that development presents good risk-adjusted returns as we think about the investment landscape today. But we also want to be judicious with capital and make sure that when we do make investment commitments, that those are good risk-adjusted returns. And there's possibility that if we need to raise capital, that we're going to do that for projects that our stakeholders, whether it's our equity shareholders or our fixed income investors or bankers, view as good uses of that capital.
So as we were talking, setting this up, we were talking about the Sunbelt focus, and then, as we briefly mentioned, Pittsburgh. For those that don't quite know the history, how does Pittsburgh fit into this? And, in case they aren't aware, what is the outlook there? Is this a move on to a different market opportunity, or, how do you see that evolving?
Yeah, so Pittsburgh is a market that we entered in 2011. And it was a little bit of a different market for us, right? We're largely Sunbelt focused, as you mentioned, David, headquartered here in Raleigh, North Carolina, where we started, and most of our markets are in the Sunbelt. When we went into Pittsburgh in 2011, there was a theory, one, that Pittsburgh had kind of evolved as a city, so it wasn't the steel city anymore. It was not really an industrial town. It was largely driven by financial services, with headquarters of PNC and BNY Mellon, and then also a lot of healthcare companies. So Highmark and UPMC are both headquartered there, both large healthcare companies that were there, and then a lot of law firms and other professional services firms that were in the city. And so we went in, we bought what we felt like was the best office complex in the city, PPG Place. It was in the low 80s in terms of occupancy at the time, and had operating expenses that were running at about $14 a square foot. We felt like we could, one, bring that lease rate up north of 90, and take operating expenses down by $1.50 to $2 a foot. And so we did that subsequently over the next few years, and brought occupancy into the mid 90s, brought operating expenses down about $2 a foot, and really drove NOI significantly higher. And that worked really well. And then Pittsburgh was impacted probably more significantly than any other market that we operate in by the pandemic. So part of the issue with Pittsburgh is there's lots of topography issues with the rivers that are there. The commuting patterns make it challenging to get into the city. And what we were talking about earlier with AI, because of the headquarter locations that are there between the financial services companies and the healthcare companies that are there, there's a lot of administrative back office job functions in the city because of those headquarter locations that are there. And it was challenging to get those workers back into the office, given the commuting patterns that were there and the nature of their jobs post-pandemic. And so what that meant is there's a lot more vacancy within the downtown Pittsburgh market than was the case prior to the pandemic. And fundamentals there have suffered. In addition to that, our assets that are there, while they're very good, high quality assets, they also were developed in the early 80s. And so you've got, kind of 45 years of age on those buildings, and they tend to be a little bit more CapEx intensive. So for all of those reasons, we've stated that, our plan is to exit the Pittsburgh market and then kind of redeploy that capital largely into markets like Dallas and Charlotte, where we've entered over the past few years and have been growing and see better long-term returns.
You said, let's say, when you plan on exiting Pittsburgh by? Is it like by the end of 26, 27, or is it still open-ended?
It's open-ended. We've said we're not going to be forced sellers. So, but I think we would like to exit, sooner rather than later. I think what we have, so we have the PPG Place, the original asset that we bought. It's got 6 buildings. It's got 1 tower that's almost 1 million square feet, and then 5 smaller buildings there for that PPG Place complex. And then we have another building called 625 Liberty that's a couple blocks away. 625 Liberty is a little over 600,000 square foot building. That one's on market today. And so it's possible that we may transact that during 2026. I think if we hit the high end of our disposition guidance, it's likely that 625 Liberty would be part of that. PPG Place will take a little bit longer. So PPG Industries is the anchor user there, the namesake customer that is in that building. And they have a lease expiration that's in 2031. We're talking to them about, potentially kind of what their long-term plans are. So I think if we solidify them and solidify the rent roll within PPG Place, then it probably becomes a much more liquid asset and a candidate for sale. And if things go well, that probably could be a 2027 event potentially.
I'm going to shift gears a little bit because you just mentioned tenant role. Now, we talked about your top 10, Bank of America at the top, financial services, all that stuff. When you think about the world of retail, I know completely different universe from you, so not apples to apples, but the retail players have what they call a tenant watch list. Party City, Michael's, pick your favorite store. They're on our watch list, potential for some issues. Might be different in the world of office. Are there tenants on your office watch list there?
Yes. So we have a very kind of robust process that things will happen on that will tenants will go on our watch list for a number of reasons. So we have a number of triggers that might cause a customer to go on a watch list. So sometimes it's just they put sublet space on a market. It's an automatic trigger. They go on our watch list. Doesn't mean that we're going to do anything from an accounting standpoint in terms of reserving any of their future rent or anything like that, but just it's a trigger that goes on there. So we have about 1,800 customers across our portfolio. There's a bunch that kind of get triggered to put on the watch list, but most of those don't result in any kind of action, and there's never a late payment or anything like that happens. We do have a few customers that are have some payment issues, that have some business issues that are there. They tend to be relatively modest in nature. So we have roughly annual revenue that's kind of 825 to 850 million. Typically what we budget for, just to give kind of a sense, we generally budget somewhere between 3 to 4 million for bad debt expense across, like in a given year when we start out a year.
So that's like what, a 0.5%?
Yeah, and last year, to be perfectly candid, I think we might have had in the neighborhood of $1 million of kind of exposure in terms of bad debt. So that's been very
de minimis is what you're saying. Very de minimis.
Yeah. It's in that 25 to 50 basis point range on an annual basis, between both and that combines both lack of cash collections and then also write-off of kind of straight line rent, and they're roughly equivalent between those two line items in terms of the bad debt expense that we may incur.
So when I say Sunbelt office and REITs, that pool is really only a handful of players, and I mean like less than a handful that have that true focus.
Mm-hmm.
Personally, the first one that comes to mind for me would be Cousins, obviously.
Sure. Yeah.
We're not talking bad about Cousins or any of your peers whatsoever. But for those that aren't familiar, what is the upside of Highwoods versus those same set peers?
Well, I mean, look, they're well-run companies, so I'll kind of let them speak for themselves. But I mean, from our standpoint, I think the way that we think about things, one, we feel like we're in very good markets overall. Number two, I would say that we're very diversified across not just markets, but also kind of like our customer base and the industry concentration that we have there. So our largest market is Raleigh. It's in the 22 to 23% of NOI range. Then we've got other markets that Nashville will be our second largest market, Charlotte, Atlanta, and then Tampa, Dallas, Orlando would kind of be our major markets that are there. So we're pretty well diversified across the Sunbelt. We also have a very consistent track record of just financial performance and long-term returns. And so I think for us, like you can expect that we will be very consistent. So I was looking at this right before our earnings, but if you look at our projected earnings outlook for 2026 and you compare that over the past 15 years, we feel like we're at relatively trough earnings levels. Last year was trough, but this year it's still fairly low. But if you go back over the past 15 years, that's still a compound annual growth rate on FFO of 2.5%. And so we feel like that's a little bit lower than what we ought to be. We think we ought to grow at a compound rate of 3% a year. And if you staple on a dividend yield that's in that 6.5% range that's there, but 3% growth on that, you get a total return without any kind of multiple expansion or yield compression that's high single digits, close to 10%. And we think that the valuation is also kind of in our favor as well, because we do think that we get hurt a little bit on current valuation with exposure to Pittsburgh, exposure to Richmond, Virginia, some of the slower growth markets that we've been exiting and are part of that 375 million of sales that we've done so far this year. So I think we've got a pretty good consistent track record. And then what I would say is on top of that, when we look at the ability to capitalize on future growth, one, I mentioned earlier, just like we think there's very good rent growth across our portfolio. And then we think we're going to be able to build the pipeline of future growth, sort of both literally and figuratively, with a development pipeline as we announce projects over the next couple of years going forward. And so you'll be able to see a clear pathway of future growth. So we think those are compelling options.
You basically teed up that next question. So we've mentioned exiting Pittsburgh, focusing on your core markets. If you had to look in the crystal ball, looking 5 to 10 years down the road, how do you think that geographic footprint continues to evolve? Do you see Orlando and Dallas moving up that list? Do you see potentially, let's say, new Sunbelt markets, if the right opportunity presents itself, entering the fray? What do you think that pie looks like down the road?
I think I would say that certainly we think Dallas will become a bigger market. I think Charlotte will become a bigger market for us. We only entered Dallas in 2022. It will be about 7 or 8% of our NOI upon stabilization of 23 Springs, which is fully leased up as it stands now. But some of those leases have not yet commenced that are there. And then Charlotte, which we entered in 2019, just right before the pandemic hit, that is now will pro forma be about 16, 17% of our NOI, and our will end up being our third largest market after Raleigh and Nashville, upon stabilization of our buildings there. So I would expect that those two will grow. I think you'll always continue to see us be a sizable presence in Raleigh. We have a lot of growth potential in Nashville. And then it's been a little bit more challenging for us to find growth in Orlando. So we'll see how that evolves. I think if we found good investment opportunities there, we certainly, the dynamics there are healthy and good. And then Tampa is another market where we've had good success, and you could see that market be a little bit bigger. But I would say I think the opportunity set's probably a little bit more in Charlotte and Dallas. So just from a denominator effect perspective, percent of NOI, you may see the Florida markets a little bit lower, but only not because they're smaller markets for us, but just because it's on a bigger pie. And then lastly, new markets. We look at new markets that are there. I think we feel like there's a lot of opportunity, and I don't think we feel hamstrung by the markets that we're in terms of opportunity set to deploy capital. But I think if an opportunity arose, we certainly looked at a market like Austin, Texas a lot. So that's a market that fits well within kind of the framework that we operate in. So it's something that we would pay attention to. We've looked in the past at markets like Denver and Phoenix. So they're probably, I would say maybe that's a little bit less likely, but something that we've looked at in the past. Potentially South Florida is something that we would pay attention to as well. But I'd say it's possible for a new market entry, but I wouldn't say that it's something that we're acutely focused on, because I think we've got plenty of opportunities to grow within the existing footprint.
Obviously, as you know, there's really not much you can do about your share price. Sure, you can go out and, buy stock on the buyback. You can issue stock with the ATM, but you can't control your share price, really. But what you can control is your dividend. And you briefly walked us through your dividend. So, as REIT investors, as income investors, for us, we focus on the dividend part of the equation. So talk to us about coverage and safety of that dividend. And more importantly, let's say future keys to growth of that dividend.
We're getting a lot of questions on the dividend in 2026, just because the nature of kind of the office business cycle, and when things start to improve, paradoxically, kind of your cash flow is almost at its lowest point. And then when things start to kind of peak and roll over is actually when your cash flow tends to get at its highest level. So our best cash flow year, just for context, was 2021 when occupancy was declining and our lease volumes were very low, because there's just not a lot of leasing capital spend that's there. And when you're not doing a lot of new leasing, you have very little free rent across the revenue stream that's there. So we're in the opposite position now where we're building that base of future cash flow, but building of that base requires capital investment up front, TIs and leasing commissions as you build occupancy. You spend that first, then a customer moves in, they have a lot of free rent, then that free rent burns off, and then you enjoy sort of the cash flow for the remainder of that lease. So for this year, our cash flow is low. If you look at through the first 6 months of the year, I think we were about $24 million less free cash flow in the door than dividends that we paid out. So if you annualize that, it gets close to $50 million. One, we don't think it's going to keep at that pace for the second half of the year. So I wouldn't expect that annualized rate of roughly 50 million shortfall to exist for this year. But I do think that we'll be below that $2 payout in terms of operating free cash flow that comes in the door. But what we can point to and what we have high confidence in is we have a set of assets that we coined this phrase roughly a year and a half, 2 years ago, called the core 4 assets where occupancy is low, and 4 development assets, so 8 assets in total, where there's about $40 million of NOI upside relative to our current run rate. Those are almost all leased, so that NOI will come online as time passes and those leases commence. So that's about $40 million more of upside. Then what we've been running at so far this year, I think in the first half of the year, we spent $86 million in terms of TIs and leasing commissions. So that's an annualized rate that is about $170 million a year. We really believe that a normalized level for us in terms of TI and lease commission spend, and we can walk through how we get there, but I won't bore you with it, is about $110 to $120 million. So conservatively, let's just say that we're, that's, I'll even haircut that a little bit and say that that's another $40 million of additional annual cash flow that we think that will come in the door for us. And then finally, our free rent levels have been high as occupancy has started to build. So we started this year at 85%, we're at 85.7 as of June 30th. We expect to be around 87.5% at the end of the year. Our free rent levels, non-cash rent, is running at about 45 to 50 million in 2026. We think that number should be in the $25 to $30 million range. So that's another $20 million of annual cash flow. So you add all that up, and we think that we've got $100 million more of kind of normalized cash flow that will come in the door relative to kind of where we've been in 2026. So we've got a lot of confidence that our operating cash flow will get to the point where we were a few years ago, where we were generating $50 million of free cash flow above the dividend level. We think that we'll get that compared to a $2 payout. And when that occurs, then that likely spurs kind of dividend increases. Our general policy is probably to pay out kind of our taxable income in the form of dividend. Our taxable income was around $2 a share in 2020, 2021, because interest rates rose and our occupancy dipped. That taxable income has come down. And so it'll probably take us a couple of years to get back to that $2 level, but we think we'll get back there in terms of taxable income. And then as that rises, then our dividend will probably track that. And we think that'll grow at that roughly 3% a year rate kind of over time, which is part of that value equation that I gave you, where it's a 6.5% current income, 3% compounded growth over time, kind of gets you into that high single digit, almost 10% total return with dividend, with income and growth.
Another very interesting topic that we've seen in the world of REITs, and not the world of office REITs, than M&A. The M&A machine is alive and well in the world of REITs, as you know. The lending window is as wide open as it gets. You can go out and raise $700 million before the end of the trading day today if you wanted to. You could go out and raise $500 million in a forward equity offering if you wanted to tonight. Like, money is up, but it's all M&A right now. What's your thoughts about office landscape M&A. You think there's something there? I've always joked, I'll say it, Highwoods Cousins would be a hell of a combination. The New York guys getting together, obviously. But, you and I have been around the block a couple of days. I mean, you and I remember the EOP speaker deal from way back when, EOP, Rex and Vornado, all that stuff. That seemed like to be really, frankly, the last mega office deal that we saw in our sector many, many moons ago. Um, we have the Piedmonts, the Brandywine, some of the smaller guys that are out there, and we're not going to talk about them necessarily. But what's your thoughts about M&A in the office REIT sector?
I think it's challenging. I think, so I'll just say from if we were thinking about M&A from our side and thinking about targets that were out there, it's challenging given we underwrite a lot of office real estate, and to find something that kind of makes it through our screening process, kind of what, the way I think about real estate, the way Ted thinks about real estate, the way other senior folks on our team think about real estate, and then get an acceptable return. It's very few deals that make it through that where then we feel good about an investment that's there. So, and the misses are kind of painful, right? As we're thinking about now in terms of assets that we're selling. I mean, it's painful to sell assets. So to find a large organization that is there that then we think makes sense from a strategic fit, we like all the assets, we're getting what we believe is a reasonable price, the expense of going through all that M&A, it's hard to kind of make those things work. So I think it's just challenging within the office space. There may be a little bit more homogenized product in some of the other property type sectors that are there. So, but I think that it's a difficult thing for office. With all that said, look, if someone came to us and was like, hey, they're going to offer us, what we think is fair value for shares, and of course we're going to listen and do what's right in terms of our fiduciary duty for our shareholders. But I think for us to kind of go on offense from an M&A perspective, it's a very high bar, and it'd be tough to have things work. But we'd certainly pay attention, but it's a pretty high bar.
Besides the Carolina Panthers season that's coming up here, or your Hurricanes for another great season, what else is keeping you up at night these days?
Oh, yeah. Yeah. We're still on high from the Carolina Hurricanes with the Stanley Cup. That was a lot of fun.
Yeah. Rub it in.
Great for the city. Yeah. I mean, I think we, as we were talking about earlier, we think there's a lot of good risk-adjusted returns in development that we see. I think acquisition opportunities are probably a little bit more challenging. Development creates unique challenges in the sense of the development cycle is often kind of 3 years that are there. And while I would say a lot of the things that we're looking at don't have a lot of leasing risk associated with them, we still think about, are we going to fund that efficiently? How do we manage kind of sources and uses when we've got commitments that are there? We tend to, I think you alluded to this earlier, but we're an office REIT, so we're used to not having a cost of capital advantage and having our equity be in a zone where it makes sense for us to issue. We've issued very little equity over time. So when we think about funding commitments, we think about asset sales and what we can do and how we can raise capital with the assumption that the equity markets are not going to be available to us. So that tends to be a lot of what we think about as how do we fund our business with the assumption that the equity markets aren't there, and are we doing the right thing by thinking about the investment opportunities that are there. So I'd say that's probably what occupies a lot of kind of our discussion and maybe concerns and what keeps us up at night. So that's probably the biggest thing that's there. And then, there's always little things here and there, but that's probably the biggest one.
So just like when we did the 5 and 5, we had the little elevator pitch, and as we've come up to the end of the session here, we're going to do another elevator pitch. Maybe this time we can go a little bit longer on the answer. But
Sure.
quite simply, why Highwoods? What's the value proposition this year and beyond?
Yeah, I mean, I mentioned, so I kind of mentioned the very quick, sort of 10-second pitch, right? Of just like, look, you get this good income, you get, we think we've got good growth that's there. That's kind of your high level number that's there. I think if you're going to get a little bit more granular and dig in a little bit, here's kind of what I would say. We started this year, and excluding land sale gains, we said that our FFO outlook was going to be $3.46 a share at the midpoint of that range. And we told you we were going to sell somewhere around $240 million worth of stuff that was there. This year, we have sold $375 million. So we've sold $135 million more than what we thought. And we're keeping that excess capital in cash on the balance sheet. So we've sold stuff at roughly an 8 cap, and it's earning low 3% today on the balance sheet. So we're being very inefficient in terms of our balance sheet, admittedly so. But with that, we still have raised our FFO outlook for this year by a penny because our core operating performance continues to get better. And so what I think we're going to be able to do is drive really good or good earnings growth over the foreseeable future with our balance sheet improving, which has happened already this year, and building that pipeline of easily foreseeable future growth that's there, while still delivering good growth in the near term. And so being able to do that, we think is going to be a big benefit to us, all while exiting the non-core pieces of the portfolio that candidly have hurt a little bit of our operating metrics over the past few years. So we think we're going to be able to deliver good earnings growth, build a pipeline of future earnings growth, and improve the portfolio quality and improve the balance sheet kind of as we go forward over the next few years. And we think that's really going to result in an improved valuation metric for us as a company over time. And so we think what I said before is we think our long-term growth rate on the existing portfolio is probably somewhere in that 3% range, give or take. I think if we're able to make the portfolio transformation that we think we're going to do over the next few years, we think that growth rate is going to accelerate, which should then just lead to improved valuation for us and hopefully a growing distribution stream over time.
Well, Brendan, I can't thank you enough for a very enlightening hour of conversation here, opening up a lot of eyeballs, seeing how Charlotte, Raleigh, Dallas, all these markets are evolving and how your footprint continues to grow and where it's going, back to the hockey term, where's that puck going? And, it's going to be very exciting to watch this. And so thank you again for your time. And obviously, if anybody has any questions, feel free to reach out to me, reach out to Brendan, but keep an eye on the story because, again, they've already talked about exiting Pittsburgh, redeploying those assets, growing the balance sheet. I mean, a lot of good stuff here to keep an eye on. So, best of luck. And I look forward to talking to you again here in the very near future.
Yeah, thanks, David. Appreciate your time, and thanks, everybody.